Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Credo Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so I want to start today with what feels like the invisible part of the whole AI revolution.
The invisible part.
Yeah, we spend all the time talking about the brains,
Mm.
the GPUs, the NVIDIAs, the actual chips. It feels like that's where all the oxygen in the room goes.
That's fair. It's the sexy part of the trade, right? Everyone wants to talk about how fast the brain can think.
Exactly. But they're not really paying attention to how fast the information actually gets from the brain to the muscles.
Right. And if the connections are slow, the whole system is slow.
You could have the smartest supercomputer ever built,
Yeah.
but if the plumbing, the actual wires connecting everything can't handle the speed, you've basically got a Ferrari engine in a golf cart. You're just throttled.
And that is the perfect lead-in to Credo. This is what we're calling the AI connectivity inflection play. They aren't building a better brain, they're solving the physics problem of moving all that data between the brains.
Without melting the data center.
Or bankrupting the power grid. It's the
Right.
unsexy part, it's behind the scenes, and it is absolutely critical.
And looking at the numbers you built, it seems like the market has finally woken up to just how critical this plumbing really is. I mean, I had to double check these growth stats. They look like a vertical line.
It's a hyper-growth story. I mean, in the truest sense of the word.
Okay, break it down for me.
Right. So if you just look at their fiscal year 2026, Q2 specifically, they pulled in $268 million in revenue.
$268 million, which is a solid number for a company this size, but I guess context is everything here.
It is. That $268 million, it isn't a steady climb. It's a 20.2% jump from the previous quarter.
Just from Q1 to Q2.
Yes. But the real headline is the year-over-year number. We are looking at 272% growth.
272%, that's ludicrous. It is. Usually, when we talk about a high-growth stock, we're excited about, what, 30, maybe 40%? 272 feels like a crypto coin, not a serious hardware company.
And that's the healthy skepticism you should have. But the data suggests this isn't just some one-quarter fluke. If you zoom out to their full fiscal year 2025, they did about $437 million in revenue.
Okay.
That was up 126% from the year before that. So you're seeing an acceleration of growth. This is real demand, driven by that massive AI data center build-out.
So they doubled, and then they almost tripled after that.
Wow.
But here's where I always get a little nervous. We've seen this movie, right? Companies growing at all costs, burning cash just to get market share, promising profits someday.
That's the trap.
Is Credo falling into that trap?
That's actually the most impressive part of this whole story. They've executed this massive pivot to profitability. They're not just selling more, they're keeping the money.
Okay, prove it.
Yeah.
What's the bottom line look like?
For fiscal year 2025, they posted a net income of $52.2 million.
$52 million in profit.
And the year before, they lost $28.4 million. So that is just an enormous swing. They went from burning cash to printing it. And in the most recent quarter, it was a blowout.
Right, I saw the headlines. Wall Street completely missed on this one.
Completely. The consensus estimate was for earnings per share of around 49 cents. Credo delivered 67 cents.
Whoa, that's a 37% beat.
A huge beat. And you have to understand, this wasn't just a lucky quarter. This is the fourth consecutive time they've beaten earnings estimates.
Ah, so there's a pattern.
It's a pattern. It tells you the analysts are consistently underestimating the leverage in this business.
Let's unpack that word leverage. What does that actually mean here? Are they just charging more because demand is so high?
It's a mix of that and just incredible internal discipline. So first, their gross margins, what they make on each product, are stable at around 65%.
65% for hardware. That's almost software territory. That tells you they have something special that people will pay up for.
Exactly. It's a premium product. But the leverage really shows up in the operating margin. So this measures how efficiently the company runs itself.
R&D, marketing, all that.
All of that. And in Q4 of fiscal 25, their non-GAAP operating margin hit 36.8%.
36.
Yeah.
That is exploding. How?
It's fascinating. They're spending a lot on R&D, right? About $146 million. But because their revenue is skyrocketing, that R&D spending as a percentage of their income is just dropping like a stone.
So they're getting more bang for their buck.
Precisely. It went from eating up almost 50% of their revenue down to about 33%. They don't need to double their R&D to double their sales. Every new dollar they make, more of it drops straight to the bottom line.
They're scaling efficiently. Okay, so the financials are a machine, but let's get to we keep saying plumbing and connectivity. What are they actually selling? I'm assuming it's not the $5 HDMI cable I got on Amazon.
No. Please do not plug that into an AI server. You'll have a very bad day. They specialize in something called active electrical cables, or AECs.
Active is the key word, I'm guessing.
It is. So picture a hyperscale data center. Racks packed with GPUs. They're hot, they're power hungry, and they need to move just insane amounts of data instantly.
Okay.
Traditional copper cables, the passive ones, are cheap, but they have a physics problem. The faster the data, the thicker and shorter the cable has to be. You eventually get to a point where it's so thick it blocks airflow. It's just too clunky.
And the alternative is fiber optics.
Right. Optical is great, it's fast, but it's expensive, and crucially uses a lot of power to convert electricity to light and back again. For the short distances inside a rack, it's total overkill.
So Credo's AECs are the Goldilocks solution.
They are the solution. They put a tiny, specialized chip right inside the cable connector itself.
In the plug?
In the plug. It acts like a signal booster and a cleaner. It retimes the signal so the cable can be thin and flexible like fiber, but it's still copper, so it's cheaper and uses way less power than optical.
It's a smart cable.
It's a very smart cable. And in a world where data centers are literally running out of electricity, saving a few watts on every single cable in a building that has millions of them, that is a massive value proposition.
That makes perfect sense. But is it defensible? Can't a giant like Broadcom just copy the chip?
It is highly defended, and we got validation of that recently when they signed a patent license agreement with 3M.
The Post-it note company.
They do a little more than sticky notes. 3M is a materials science giant. This agreement basically sends a signal to the market that Credo's IP is the real deal. It's protected.
It's a stamp of approval. Okay, but who's buying this stuff?
The biggest fish in the ocean. The hyperscalers.
Amazon, Google, Microsoft.
Exactly. AWS, Meta, those are the main clients.
Okay, so that's a double-edged sword. Great customers, but also concentration risk.
It is a risk, but this is where their real moat comes in. The switching costs are incredibly high.
Explain that. Why can't Amazon just swap them out for a cheaper cable next year?
Because these cables get designed into the server architecture, the whole system is calibrated to work with that specific chip in the Credo cable. If you want to switch, you're not just swapping a cable, you might have to redesign the whole rack. Risk downtime.
And downtime for AWS is measured in millions of dollars a minute.
Per minute, yes. So once Credo gets designed in, they tend to stay in. They become embedded in the nervous system of the AI build-out.
That stickiness is the holy grail.
Okay,
so hypergrowth, profits, sticky customers. Let's talk about the stock. Because, wow, it's up 284% in the last year.
It's been an incredible run.
Yeah, but for anyone who wasn't holding it, the immediate thought is, I missed the boat. It's around a 130 a share. Is there any juice left?
That is the million-dollar question. And despite that massive run, the analyst community seems to think the answer is no, it is not too late.
Really? Usually after a 300% run, you start seeing downgrades.
Not here. The consensus seems to be that the market still hasn't fully priced in how big this wave is. The average price target right now is around $216.
Hold on. From 130 to 216.
That implies a potential upside of about 67% from where we are right now. Firms like Craig-Hallum, Roth MKM, they're all maintaining strong buy ratings.
And to fuel that growth, do they have the cash? If the economy turns, are they okay?
They have a fortress balance sheet. They're sitting on about $104 million in cash and almost zero debt. Their current ratio is 7.81.
7.81. So for every dollar they owe in the short term, they have almost $8 in the bank to bill it.
Exactly. They can self-fund their growth. They don't need to go to the bank. They don't need to dilute shareholders. They control their own destiny.
Okay, you're painting a very rosy picture. I need you to play devil's advocate. What's the catch? Because I saw something about insider selling that had some people spooked.
Yes, that is the main bearish argument right now. You're talking about the CTO, Chi-Feng Cheng.
That's the one. He sold a ton of stock.
Right. He did. Over 2 months, he sold about 340,000 shares, which is worth around $51 million.
$51 million. Okay, when the chief technology officer, the guy who built the tech dumps, $51 million in stock. Isn't that a massive red flag? It feels like he's cashing out at the top.
It's a natural reaction to think that. What does he know that I don't? But we have to look at the context. The headline is scary. The details tell a different story.
Go on.
First, even after selling all that, he still owns nearly 12% of the entire company.
He still has that much skin in the game.
Massive skin in the game. And if you look at the individual sales, each one was less than half of 1% of his total stake.
Oh, so this wasn't one giant panic dump. This was more like trimming.
Exactly. It looks like standard portfolio rebalancing. You have to remember the stock tripled in a year. Any financial advisor would tell you to take some chips off the table. It's just prudent planning.
Okay, that context is key. So if he's selling a little, who's dying?
And that's the other key part. The institutions are buying. We're seeing funds like Estate Counselors LLC put in over $2.5 million, Alta Wealth Advisors almost $2 million.
The smart money is loading up.
Right. When you see insiders trimming a bit after a huge run, but the big funds are using that opportunity to accumulate shares, that's usually a very bullish signal.
Okay, so the insider selling might be a nothing burger. What about valuation? What's the PE ratio on this thing?
It is high. The price to earnings ratio is sitting around a 112.
Oof, 1 in 12. That is rich. That is priced for perfection.
It is a premium valuation, absolutely. But you have to view it through the lens of growth. When a company is growing earnings at these rates, a high PE is common. You're paying today for those future earnings.
But it means if they miss an earnings report.
The stock gets punished. Hard.
Yeah.
That's the risk. And you still have that customer concentration risk. It's a high-stakes game.
So looking forward, what are the catalysts? What gets us from 130 to that 216 target?
A few big things. First, their next earnings report in late April. Their own guidance suggests 67% sequential growth.
67% quarter over quarter.
It's aggressive. If they hit that, it proves the story is still accelerating, and it validates that high PE. You need to watch the earnings reports from the hyperscalers themselves. Amazon, Google, Microsoft. We don't care about their profits as much as their CapEx guidance.
Their capital expenditures, how much they plan to spend.
Right. If they say, we are increasing our spending on AI infrastructure, that's a direct check being written to companies like Credo.
It's an indirect confirmation of demand.
Precisely. And then there's the wild card, M&A.
A potential buyout.
There's always speculation. Credo is a pure play leader in a critical niche. A bigger player like Broadcom or Marvell might just decide it's easier to buy them than to try and compete with them.
All right, so taking all of this in, the growth, the risks, the valuation, what's the final verdict? Put a score on it.
Taking everything into account, the explosive fundamentals, the strong balance sheet, the institutional buying, I'm giving this a bullish score of 8.5 out of 10.
8.5. That's a very high conviction score.
It is. The thesis is just so clean. Credo is a pure play beneficiary of the AI infrastructure build-out. It's one of the clearest ways to invest in that theme.
So what's the strategy? Just jump in now.
I would say the strategy is to buy on weakness. The sector is volatile. The stock pulls back for whatever reason, that's your entry point. The target is 216 plus within a year. But, and this is key, this is a multi-year hold.
Not a quick trade.
No, this is not a swing trade. You want to own this for the next 2 to 3 years as this AI build-out really unfolds. That's where the real value is created.
Patience is key.
Got
All
it.
right, there you have it. Credo Technology, the smart plumbing of the AI revolution. Definitely one to keep on the watch list.
Absolutely. A fascinating story.
Thanks for tuning in to Smart Wealth with Joshua.
Don't forget to subscribe for your daily dose of market alpha.
We'll catch you in the next one.